Right.
So, use that as a revision guide anyway. And what we're going to do then, we're going to focus more on the actual exam papers. So we go through 2 CPA questions and 2 IIPA questions. What you'll notice with all these is, once you have the layout sorted, it's going to be exactly the same. So I'd say the best approach to doing this is write out the layout first, okay, in the exam, and literally then take it one at a time, right? Because to be honest, 9 times into the stuff in every question is nearly identical. So if you look at the handout there, International Company Standard, that one. Okay. So you get that one. So you get that one now. Oh, you get it. Yeah, you take one of those. If you look at the very last page of it, on the back of it, I'd say. Yeah. On the very last page of it, anyway. It's just a sort of layout, yeah. And what I do is I email down these slides as well. But literally in the slide, what I've done out there is just literally the full layout for us. Okay. So I suppose the main thing is there. I can just start taking down. If we talk through the heading, I think is the easiest. Right, so that's our heading. And so, with cash flow statements, right, you're looking for 3 main headings. So what we'll do now is we'll talk through every possibility that can come up under the heading, right? And so the first heading will be cash flow from operating activities. Okay, so does that ring bells, yeah? Yeah. And the starting point, the first figure, is always your operating profit. So, operating profit. And what we're going to have over here, right? If you want to just, suppose we're going to have 2 columns. Second one bigger total, right? So I'll just put an X here where we're going to put the figures. So that's our starting point. And sometimes you might have to work it out. But sometimes, to be honest, most of the time we give them to you in your profit and loss account. Now, following that then, right, we're going to add back non-cash items. So what would be a non-cash item example? So something that's in our accounts but actually no cash changes hands. What would be something? Stock. But if you're buying stock though, wouldn't you be giving money for it? Or if you're buying an asset? So think about assets though. Is there any assets that just change value but actually no money changes hands? Depreciation. Exactly, yeah. Think about your car. If you have a car worth 10,000 today, year's times worth 7, gone down by 3. So on paper it's gone down by 3, isn't it? It's like your house, the same with a house, isn't it? The house prices go up and down. It's on paper, like, no money changes hands. So any non-cash items, what you do is you reverse what you normally do. So in your normal profit and loss account, you normally minus depreciation. Okay? But we're doing a cash flow statement, so we do the opposite thing. We're going to add it back. Okay, so literally what you're doing is you're making an adjustment to what's after happening already. So what we'll be adding on is, add on any depreciation expense. Okay, so we're going to add that on. And there will be another one you may have is loss on disposals. Loss and disposal of assets. So normally you take that off. Again, that's only on paper, because think about it. If you sold the car, on paper you made a profit or loss. what you actually receive is, so let's say you sold the car for 7,000, what you receive into your hand, the paper figured in as your profit or loss. So we'll reverse that. The same then, if it was a profit, you would have added it originally, so we're going to minus it. Minus profit on disposal of assets. So I suppose really what we're doing there, since we're starting off with operating profit, we're just cancelling out what was done already, just reversing them. Now the other thing you might see as well, right, is if you think about your grants, right? Grants come under IAS 20, and if you, after receiving a grant, you should put the full amount into your bank account. But what, if you can remember back what we do with grants, it's like depreciation, you amortise it every year, so you put so much into your profit and loss account. So in theory, the amortisation is a non-cash item. So you reverse that as well. So minus amortisation of grant. Right, now I'm just literally handing out every possibility, right? Not all these would be in every question. Now the other thing then that would be a non-cash item, and I suppose we would have seen this a lot before, but goodwill. Okay? So what's goodwill again? Your reputation, exactly. Like, so if you sell your business, you might be selling with goodwill. And goodwill is like any other asset, it depreciates. But again, it's not called depreciation. I don't know if we covered this before. Impairment of assets. So literally it's the same principles of depreciation. So they might tell you in the accounts, right, you have goodwill of 50,000, and it's like any asset, you need to write it off. So what it'll say is goodwill is impaired over 8 years, so that means you write it off over 8 years. Okay? So we'll probably get into more detail of that in the consolidated income statement. But for more really, just think of impairment as being depreciation, the same principles. So that might come up in one or two of them. So what you do is you then on impairment of, I suppose the technical term there would be intangible assets. So what intangible assets would be goodwill, and the other one I see is patents. You know, so if they got a product and patent it, same thing, you'd write that off. Like generally there, I suppose from the drug industry, the pharmaceutical industry, it lasts for 20 years, usually a patent, and that's written off in over 20 years. So that's how that will work. So basically those there, I suppose if I put in one next to them, they will be our non-cash items. So no money changes hands. So is that alright? Yeah? Okay, so that would be like your first thing you're looking for. So probably more than likely, definitely depreciation, and maybe one other one will be there. Now moving on from that then, the next thing is we're looking at any changes in working capital. So literally what we're looking at there is, if you can remember back, receivables, payables, inventories. So you're just seeing have they gone up or down. So we're going to have inventories, receivables, and payables. No, I'm not sure we're leaving the question which one anyway, just in case. You might have prepayments and accruals as well, just in case. So what we're going to do is we're going to look at those, compare year to year, and see have they gone up or down. And just think again, like if I think these one always think about is your inventory, your stock. So if your stock was 200 in 2014 and it's 300 in 2015, that means it's gone up by 100, isn't it? So obviously you must have bought stock. So that's bad for cash, isn't it? And then if stock went down, that means you must have sold more than you bought, so good for cash. So just think of it like that. Same with your receivables. Receivables are your customers. So if your customers owe you less, that means they've paid you, which is good for cash. If they owe you more, it means you've sold them the goods. You haven't received money, so it's bad for cash flow. So just think of it like that. So you're looking for that, for changes in those, and we'll see those in questions tonight. So this might come up in a multiple choice question as well, and what will it be is changes in working capital. Okay, so changes in working capital. So that will be the first two sections under that heading, and you'd total them up then, and what we get is cash generated from operations. cash generated from operations.
Okay, thanks so much.
Thanks very much. Okay, so that's the first section. So is that coming back to, yeah? So like what I would advise in the exam is I'd write out that first, and at least you can't go wrong. And I just start at the top, get the first figure, and then move on and shoot it. Otherwise it can get very confusing, like if you're trying to do all the workings first, so I would do it like that. So there's two other things actually under here. So if I'll just continue over here. So the next thing, what you're looking for is interest paid. Obviously that's going to be a negative. Interest paid and tax paid. So interest paid and tax paid. Now, more than likely, you have to do a working for those. Okay, so let's put an asterisk next to those. There will be a working required. So if you do a T account, the reason you're doing a T account for those is because there will be figures owing from previous years. So you have to work out how much our tax and interest will be. So that finishes off that section. So that's the first section, and what we're going to be dealing with there is net cash flow. So net cash flow from operating activities. Net cash flow from operating activities. Now after that then, the second heading will be cash flow from investing activities. Okay. So anything that you're investing in. And again, there's a few standard things here, right? I suppose the main thing will be your property, plant and equipment, that you'll have some, you're buying or selling assets normally. So that will be the first thing. Purchase of property, plant and equipment. So obviously it's going to be negative because you're buying it. And then what we'll have is proceeds from sale. Proceeds of sale from property, plant and equipment. So it's going to be an inflow. So we'll have an outflow of purchasing property and equipment, an inflow of how much you receive from it. Other things then, just watch out for increase or decrease in investments, okay? So has your investments gone up or down? And also increase or decrease in intangible assets. So like, if we were talking about goodwill earlier, up particularly after acquiring that, so that should go in there. And the other thing then we have there is any grant received. And any interest received. Okay, so grant received, interest received. And that's it really, isn't it? It's all assets.
That's why you take out the amortization of the grant, because you're adding the whole thing in.
You're in the whole thing. And it's the same then with the intangible asset for, say, goodwill. We're taking out here any impairment and putting in the full figure. And it's the same when you're buying an asset, like, so
If an increase in goodwill, as plus.
as a negative, because it's the same, same as buying an asset. Yeah. No, I don't think that will come. It's usually, to be honest, property and equipment is usually working. I've seen a few questions where investments have gone up or down. That's it. To be honest, grants don't really come up in cash flows a lot, but they go in there. And again, interest received in the IIPA questions has come up right.
Investment area, plus or minus for increase.
Plus, if you increase, and that's thing. So if you sell it, it's a positive. So if it decreases, if it increases, you have to buy investments, so it's a negative. So again, that's that section finished. So that will give us our net cash flow from operating activities. And one final heading then. So what we have is cash flow from financing activities. So what we're looking at there is basically what we're using to finance the business. So in a company, alright, just remember we're doing sole traders and out, so all companies we're going to be looking at. So what would finance a company? Shares? Yeah.
Bank loans, overdraft.
Bank loans, all that sort of thing, right? So the first thing anyway, we look at is issuing of shares. Okay, so obviously that's going to be positive, isn't it? If you sell shares, so it's going to be a plus. And just watch out there, share premium should be included with that as well. Okay, so watch out for share premium. So you have issue of shares and share premium.
You had them all into one figure.
Yeah, put them all into one figure.
So that'd be working or something, would it?
Yeah, working. Yeah, exactly. Now, on to that then, what we'll have is if they receive the debenture or a loan, okay, so when they receive the debenture, that's positive, that's money coming in. Or what we see in some cases is a repayment of debentures. So there'll be one or the other. So issue of shares plus received debenture minus repayments. And the last thing that we have there is when they pay their shareholders dividends, so minus any dividends paid. And we balance that off, so that will give us the cash flow from financing activities. So that's line there. So what we're left with then, we have three main ones left. In our total, we'll have our net cash flow from financing, our net cash flow from operating, and the net cash flow from investing. So three. So we put the three lines together, and our final thing we have is either an increase or a decrease in cash. In cash. cash and cash equivalents. So cash equivalents would be like short-term investments. Now I suppose the beauty about this question is you can always check if you're right or wrong at the end. You know, is that good or bad in the exam?
Just have to name it if you want.
Yeah. But I suppose compared to your big long account, it's actually, it can be handy enough to find a mistake in the cash flow because there isn't too many workings out them, so you might have just added up something wrong somewhere. So just to check it in, right, to get this at the end, you'll do changes in cash and cash equivalents. Okay, so changes in cash and cash equivalents. So let's say, for example, we have 2001. So we have your 2 years, and what we could have cash, we could have bank, we could have bank overdraft, short-term investments. And we'll have one column in change. So we look at our change column in, and that will give us our change in cash and cash equivalents. Change in cash and cash equivalents. So that just checks to see if we're right or wrong. Right, so just the last thing I was talking about then is just the possible workings we might have to do, okay? Now, that is 2 or 3 T counts as the max we'll be doing. Okay, most of the information is actually in the question. So the layout is key. Now, what we might have to do is, we might just take these down as maybe some sample workings. So at least we can refer back to them and they won't change. Now, what we might have to do is a tax account, okay? Well, it could be either tax, it could be dividends, it could be interest. So, right, they're all done the same way, right? Tax paid, interest paid, or dividend paid. Right, you might have to do 3 of them, you might have to do 1, but you definitely do something. And the only time you have to do some a working for these is there's a working required. Okay, working required if there is amounts owing in current liabilities. Okay, so working required if there's amounts owing in current liabilities. If there's nothing current liabilities, there's no working required. But so what you'll be doing for these 3 figures is look at current liabilities, see if there's something owing. If there's something owing, then you'll have to do a T account. Okay? And they're all done exactly the same way. So what I'll do there is I'll just give you a mock T account. You know, to be honest, tax is always going to be a working anyway, right? So we call it tax. And like our debits and credits now will be in full swing. So what we're going to have an opening balance of tax owing, we're going to have a closing balance of tax owing, and then inside your profit and loss you're going to have tax paid, okay? Tax for the year. So the first thing I will do anyway is put in your opening and closing balances. Now this has gone back into debits and credits now in a while, okay? But tax is liability, isn't it? This is something that you owe. Now, liabilities, what side would an opening liability go on? Credit. So credit. Yeah, then your closing will be debit. So we'll say our opening balance here. So we'll have our balance brought down, whatever that is. So that'll be our opening, and then our closing will be on the debit. Okay, so if it was interest or dividends, it's the same thing. Just take your opening balance, your closing balance. The other thing that you're going to have is inside your profit and loss account. So down at the end of your profit and loss account, you'll have corporation tax or something like that. And that's your profit and loss figure, and that's how much should be paid, right? It has to be paid, it's the amount that should be paid. So that's going to go into your account as well. So over here on the credit side, we're going to have our profit and loss tax, okay, however much that is. So that'll slot in there. And if we balance off that account, then what we're looking for is how much is paid. So we're left here, and we're looking for the balancing figure. The balancing figure here will be on the debit side, and that will be our tax paid. And that's the figure that goes into our cash flow, because it doesn't matter how much they should have paid. From our point of view, we're dealing purely in cash. It's how much they actually paid over the revenue. And just think about it anyway, right? Tax paid has to be on the debit, because if you were in your bank account, what side would it be on? Be crediting your bank, wouldn't it? Yeah. So you might have to do that for interest and dividends as well. It will be exactly the same. So we'll see one there now in a second when we start the question. And just the other working then, well, I think only one more working would be for assets. And looking at some of the exam papers there, usually what they give you is your net book value of your assets, okay? So they don't give you actually depreciation, accumulated depreciation. So that makes it a lot handier, you're liable in one account. So what it will be is property, plant and equipment.
Is it a profit or loss or something on disposal, is it?
Yeah, that's what we're looking for. Yeah, property, plant and equipment. So I suppose that's one change in the positions. We would refer to everything as probably non-current assets, and under IAS 16 it's property, plant and equipment. So everything in your exam papers would be, they could just say PPE as well instead of property, plant and equipment. So they might just write down the exam paper PPE, and that's what a lot of exam papers are written down. So that's our assets. So if that's the case, right, everything is based in net book value, so that means everything goes into it. So it's the same as what we had over here. You put in your opening balances first. Now just remember, the tax here is a liability, so over here it's an asset, so the opening and closing are the opposite way around. Yeah. So we'll have our opening here, and we'll have our closing balance down here in the credit. And what we're going to have then as well is anything that takes place during the year. So what I mean by that is, we might have a revaluation. Now the revaluation could be up or down, depending. 9 times the time is usually up. So if revaluation is going upwards, that would increase your asset, wouldn't it? So what side would that be on? Debit. Yeah. So, right, revaluation would be inside here, if there was one. If they sold something in, disposal would be on the opposite side, wouldn't it? Credit. And the other thing we have is depreciation. Now depreciation will reduce your asset account, wouldn't it? So that would be credit. So depreciation expense. Now that you throw them all together if it were net book value. If in one or two, maybe if we might see a question where if you're given enough information to do a separate depreciation account and do a separate asset account, then like
If you bought something into one, so you...
yeah, and I'd say that's what we're looking for in the question. Usually they don't give you your additions figure.
So that's what they're looking for.
Yeah, so when we balance out that account, because we already have our closing balance, so the missing figure is nearly always over here, and that would be your additions. So more than likely, that's what we're looking for. Okay, how's that sound? Alright. See a question now and see. So what we're going to look at now is I have 2 CPA questions. We just forget what contributions all that's in the past, so we can, I said for not some CPA ones and see what they're made of. They're actually very much. There.
So there are 2 conditions there.
So, you can see there what we're given. The first thing we're given is our profit and loss account. Okay. Now, in the exam papers, this is the same happening with politicians. It can be called, you see here, it's called statement of comprehensive income. Technically, no, I think from the new exam papers onwards, it should be statement of profit and loss. I think is what the standards are. So I think it's the last for statement of comprehensive income. And then our statement of financial position is our balance sheet. So we're given our two separate years there. And what you see there is you see property, plant and equipment. And if you turn over to the other side, what we have is our statement of changes in equity. Okay, that really just gives us some more information. So, like what we're talking about there, what our property, plant and equipment, we're not given a breakdown of depreciation and nothing, we're not. So literally, we'll be trying your gains in one T account. So I'd say the first thing anyway, as we were saying there earlier, is we write out the layout and then we go into it. Now what I'm going to do is I'm going to do mine on Excel so I can save it. I think it's a cartoon thing as well, is it? And at least I'll have it in. And I can email it on to you in your notes as well.
What year is it from, Leon?
That is from, I'll tell you about the year here now. That's from 2013 and the other one is from 2014.
There's a couple of the figures kind of.
Yeah, I see that, the fucking photocopy must have got no idea.
Is the income tax 340 euros?
We might have to figure that one out. I have the original. Yeah, so. The original one there. Yeah, that's probably handy. That's cash flow, the name of it, isn't it?
The income tax.
Income tax is 341. I'm sure. On the opposite side then, the shares, 40 million, 5 million, so 45, 2600, retained earnings, 2595, revaluation 18300. And total equity 68,495.
So with them?
68,495. Is that alright? Okay. Right, so just remember.
You write out your layout for the cash flow first, and then you do your workings after.
Then do your workings after, right? So that's, and just what we'll do is we'll just take it figure by figure then. And at least then, like, you won't forget anything. I think that's the big thing. So just put your heading then. So cash flow statements. So you'll actually go through my writing on maybe. Okay, so that's going to be our first one, cash flow from operating activities. Okay, can you see that, Harry, again? Could I make it bigger? So the first thing there is going to be your operating profit. And we have two columns in. So, first we said then was change in non-cash items, isn't it? So, there's going to be depreciation in every question. So, we're going to be adding depreciation. And normally, they just tell you what that is. So, that's our depreciation expense. Now, like, you can write on everything, like, the next thing would be a profit or loss and disposal, right? So if you're writing profit or loss, it's only one of them, there'll definitely be a profit or loss on it as well. Okay, so profit or loss and disposal. Now, the next possibility then is, what do we say was next? Grant. So what I would do in this case, I would look at the question and see is there any grant in it. No, to be honest, a lot of the time there isn't any grant. And where you'd find that is non-current liabilities. So if we look at our non-current liabilities, what we have is bank loan. So there's not really. After that then, intangible assets, which would be, if you look under non-current assets, you'd have an intangible assets section. Like all we have there is property, plant, equipment and investments. So there'll be no impairment and that sort of stuff. So I need to worry about that. So literally, I'd say, to be honest, in most questions, depreciation expense and profit and loss and disposals. Sometimes a grant, sometimes a payment, but most of the time there isn't. Now, next thing then is we look at receivables, payables, inventories, prepayments, and accruals. So if we start with, look at your current assets, we have inventories there, so we can slot that in. And we have receivables. Now, have we prepayments? So that's not there. If we jump down to current liabilities then, payables and accruals. Right, so that would be sort of the second section and change the working capital. So that would give us the heading then, cash generated from operations. After that then, you're going to have interest paid, and tax paid. And that finishes off the first section then, net cash flow from operating activities. So, next thing is our cash flow from investing activities. Now, what we're going to have inside there will be our assets really, right? So we're going to have some sort of addition. So you can say additions to property, plant, and equipment. Proceeds from sale of property, plant, and equipment. And what you see in this one is the sold investments. If you look at your investments there under non-current assets, they've gone downwards, haven't they? So they must have probably sold them, so we put that in proceeds from sale of investments. No, and then we have interest received. That will probably be in all our questions, so we can start that in. Interest received. And again, we said there's no grant already. That should be everything I'd say. So that will give us net cash flow from investing. So then the last heading, cash flow from financing. So what we're going to have in there, and if you look at the question, we have shares and share premium rate, so that will go under issue of shares. There's a bank loan, so that's sort of interest that's gone downwards, so it will be a repayment of bank loan. And dividends paid. Now, if you look at the statement of changes in equity, there might be dividends in there, and there is, so that will be there, dividends paid.
Separate noise.
I think just put them in as one figure. Yeah. So dividends paid. Now outside of that then, that's everything, so that gives us our last thing there, cash flow from financing. And then at the end, we're going to get an increase or decrease in cash, which we'll do in a second. Right. So now we'll jump back up to the top and we'll start off with our operating profit. So, if we look at it there, our operating profit, that's basically our profit before interest and tax. No, it's not. What you look there? 2130, wasn't it? Yeah? So, 2130. Perfect. No, the next thing is depreciation expense. Now, we might need to do working for that. And the best place to look for any question is go to where you get a bit of narrative at the end. So you see the notes. If you look at note number 2, actually it tells us there, depreciation of property, plant and equipment amounted to 1860, and to be honest, it's nearly always clear as a note at the end. So we can stick that in as it is 1860, and we say that's a non-cash item, so you reverse that, so you add it on. Now, profit or loss on disposal, usually that's given as a note as well. I'll probably have to do a small working. So it says during the year, and probably one there, number 1, during the year, property, plant and equipment which had cost 540 was sold for 240. So 240 would be your proceeds, wouldn't it? This asset is being purchased in the year ending 31st of December 09. Catunda Limited's depreciation rate is 10% straight line per annum, with full depreciation in the year of purchasing and the year of sale. Okay, so we're given our proceeds, we're given our costs. Now the only thing we're not given there, when you're disposed of anything, you need to find your depreciation and disposal, okay? So we have to work out the depreciation. Now, we're doing the accounts for 2012, isn't it? So, yeah, so you have 2009, 10 and 11, and we don't count the year they sell it. Yeah, so 3 years depreciation. So if you want to just show that as a working, because we have to find out the profit anyway. So we'll do that down here at the end. So we're saying, right, depreciation on disposal. So it cost us 540, isn't it? And it's going to be at 10%. And it's going to be for 3 years. So what's that come to? 1462, is it?
No,
162.
162,000 is the depreciation.
Yeah, 162. Perfect. So that's for depreciation and disposal, 162. So if we just work out and it's made a profit or loss, so it cost 540. Right, depreciation was 162. So that will give us, if you take them away from each other, that will give us our net book value. 378. So cost 540, it's after depreciating by 162, so it's worth 378. And what were the proceeds?
240.
240. So is that a profit or a loss? A loss. So a loss on disposal there of 387, is it? No, it's not. I'm saying 138 even is 138. So a loss of 138. Is that alright? So that 138 now will go back up to our cash flow. And it's a loss. So we'll be adding on. Perfect. So that's our non-cash items dealt with. The next thing we want to deal with is our inventories. So if we look there, have inventories increased or decreased? Increase. So is that a plus or a minus? Minus. Yeah. Minus, so minus 37, isn't it? 37. So just compare year to year. Receivables in is the same story. Has receivables gone up or down? Up. So the receivables increase. So that's the same story. That means you've sold customers goods and they haven't paid you. So it's going to be negative. So what's that work out at? 610 of it. 610. Sorry, that's going to. Is that going to cost us out the zeros? It's like 600, is that 610,000? Oh, it is. Yeah. It says payables in. Has payables gone up or down? Payables have gone up. So is that good or bad? It's good. In theory it's good because you haven't paid your bills. So you haven't spent the cash. So from a cash spending point of view, it's a good thing. Payables have increased, so that's going to be a positive. So 1766. Perfect. And then we have accruals. So accruals have gone upwards as well. So in theory that's good, isn't it? You haven't paid whatever bills it is, so they've accrued up. So your cash still there. So how much did they increase by? 490. Right, so what we do there, we can add them up now. So that comes to 2074, I think. Is that alright? 2074. Okay, no. Interest paid in is the next thing. Now, we're saying earlier with the workings, look at current liabilities first to see if there's any interest owing. So if we go to current liabilities, is there any interest owing? No. So what you can do is you can just take it for granted that the amount in the profit and loss account is how much is actually paid as well. So if we jump up to profit and loss, you can see there interest 387. Yeah? So I can just go straight in. 387. No, tax, there's always something owing for tax. So if you go to current liabilities, you'll see current tax payable. Is that alright? So that means if you look at T account. So again, we'll jump down there and do that as a working. So we said it's sorry, I'm just going to do this. So what we're going to have that starting off is our credit balance, it's our opening balance. So balance brought down. And starting off there, the very last figure you see is 2,500. So 25 is our opening balance. And our closing balance will slot over here. Balance carried down 2160. Which our balance brought down and balance carried down. No, the other thing we're going to head in is what's in our profit and loss. So if you go to your profit and loss, there should be income tax in there somewhere. Yeah, 341. So that's how much they should have paid during the year. 341. Is that alright? So we're open closing with what's in the profit and loss. So what we're going to do is we're going to balance that off now. So what we're trying to find is over here, tax paid will be our figure that we're looking for. So if we balance it off, which is 2.5, so it's going to come to 2,841. So 2,841 minus 2,160, what's that give us? 681. Tax paid will be 681.
Where did you get the 340 with it?
341?
It's up on top, oh, sorry.
Is it? Yeah. Is that right? So tax paid 681. So that's the figure in, that's all we want. So that'll go into our cash flow statement and we jump back up. 681. So what we're going to put in is our net cash flow from operating activities. That's going to go over to our second column because it's the total. So what's that come to? How much?
1006.
1006. Is that right? Excellent. Okay, so the next thing that we're looking at is our investing. So we're going to have additions to property and equipment, proceeds from sale. Now we sold property and equipment, and we were given that information actually, weren't we? And if we look there in note 1, and we did our working, how much was the proceeds? 240. So that can go in there straight, proceeds from sale, 240. Now interest received, if you look at your profit and loss account, the second figure under operating profit, 126, the top there, so that's money coming in. Stop that in, sorry. 126. And proceeds from sale of investments. Now, we're not given any note in it. Sometimes you might say it's a note. So if we go to our investments, you'll see there in 2011 investments were 19,625 and in 2012 they were 15. So obviously they're normal value. So we have to assume, right, they haven't told us anything. We have to assume that they sold them and they sold them for that amount. So that would be 4,625, wouldn't it? So we're not given any information, so just assume they sold them for that amount. So 4,625 for our investments.
Should you make a note of that and say?
I'd say maybe just make a note of yourself. I assume this is the selling price as no further information is given. Sometimes they might tell you, like, you know, you can make a profit or loss on them, but to be honest, I suppose investments, well, in theory, the profit. Yeah, it might be no harm to try a note. I'm assuming this is the selling price and the sales proceeds, so you can't go wrong then. So really, what that leaves us with is the additions to property, plant and equipment. So what we're trying to do there is a working for that. So as I was saying there earlier, we can show them all into one account. So if we jump down to our workings again, and we're going to have property, plant and equipment. Okay, we're going to have a debit, we're going to have a credit. So we start off there with our balance brought down. assets, property was 95,300. Just give me something like a room, and the closing was 101,650. Alright? Now, remember what we were saying earlier, everything goes in there, we're looking for additions. So, think about the debit side first, revaluation. Okay? Now, all we're looking for is how much they went up by. So, the easiest place to find that is your statement of changes in equity. So, if we turn around there, it's just above our notes. If we look at revaluation, how much did they increase by? 3240. Revaluation 3240. Is that alright? Yeah?
Income for the year is 224, so
Yeah.
it means they went up.
It went up, yeah. You'll never take the full value of revaluation. Like what you might see, if you go back actually to your equity and liability section, yeah? What you see there is, if you say, in some questions you might be given your statement of changes in equity, you see your compare year to year. 2011 was 18,300, 2012 was 21,540. So it's only the increase you always take. Okay? So that's the same increase we had there. Now, if we jump over to the other side, then what we have on the other side is our disposal. Now, our disposal, how much, and just remember, net book value, these are all net book value figures. So how much was it? 378 was our net book value, yeah? And we have that, just to refresh there, that was up here. In our working, 378. So net book value. So that's, I suppose, that's something you might put in your cost there, so in a hurry. So just watch out for that. And the other thing then is your depreciation expense. So we had that. How much was that again? 1860, wasn't it? It was no 2 anyway. 1860. So that's everything sorted now.
Don't wait till the depreciation disposal here.
Oh no, you don't put that in, no. Only if you're doing a separate depreciation account. Yeah. Perfect, so what we'll do is we will balance it off, and like the tax there, what we're looking for is additions. So our total there is 103,888, I think. 3,888. So that leaves us with 5,348. I think we balance it off. Let's just check that. 5,348 is the balancing figure. So that will go up then. Will that be a positive or a negative? Negative, yes, because you're buying it. Yeah. So 5,348. So when that works out, that's going to go to the negative 357. It will be our negative net cash flow for investing activities. Alright? So we're just moving on into our shares for our financing activities. So again, just look at your shares, and remember what we said earlier, include your share premium in it as well. So if we look at our shares, share capital has gone up by from 40,000 up to 48, so that's an increase of 8,000, and our share premium has gone from 5 up to 13, so that's an increase of 8 as well. So altogether, it's gone up by 16. So 16. Okay, so 16. Is that alright? So share capital and share premium together.
You don't need to do working for that, you just add up.
Yeah, exactly. Yeah. You can show how they're working as well, but I suppose just bear in mind time-wise. Yeah.
But they won't expect you to say,
Right, so it's practice or
Well,
not.
it should.
It's obvious.
no, you don't know the
Yeah.
commission
No.
and the bridge
Oh,
don't.
Yeah, no, there's no need. I say the only working show is your T account. Yeah, that's it, to be honest. Repayment of bank loan. So if you look at our loan has gone downwards. It's gone from 48.8 down to 42.311. So that's a repayment of loan. So that comes to 6.489, I think, is it?
Yeah.
Right, that will come off. And then we have dividends paid. So that's, we said this inside our statement of changes in equity. And there's two of them, right? Preference dividends and ordinary dividends. So 550 in total.
What about 1528 and
The total, where is that? The total 1528. That's only the profit for the year, I'd say. Yeah. So we have 200 and we have 350. So that's 550 in total. So that goes our cash flow from financing. So that gives us 8961 positive. So overall then we're looking for an increase or decrease in cash. So I think it's going to be an increase in cash and cash equivalents. So we have three main headings there. So we have 896, 8961, 357, plus 1006. 9610. You can treat those together. The three in our total column. So an increase in cash of 9610. Now, just check if you're right, and do a quick check, right? So we do the changes. Equivalents, okay?
Sorry,
Yeah,
James.
no matter.
There's no.
Yeah, 2 seconds, yeah. No matter.
During the cash flow, the industry has like the ABC into travel and the ABC solution. Yeah, it's just brilliant. I just have to see what that would be.
we just take 3 more, or maybe?
I think that's a lot. Thank you.
So change the cash and cash equivalents. So what we're looking for is either bank overdraft, short-term investments. So if we look at our current assets, we have cash and cash equivalents there, don't we? So we have 2011, 2012, and then we just have a column for change. So in 2011 there was no cash, in 2012 there was 8,600. So that's a change of 8,600. And there should be a bank overdraft, let's say, if you look at current liabilities. Bank overdraft. It was 1010, and now it's 0. So that's a change, a positive change, isn't it? 100. So that works out, doesn't it?
Yep.
So 9, 6, 1, 0. Increase. So that's just confirms you're right. Just do that, Henry. There'll probably be 1 or 2 marks going for that, just to show. And it's for your own self because you know you have a full 25 marks in.
There's a very strong chance that you probably will need that.
I think so, yeah. Like it's one of the main things in the publishing. Look at the exam papers there now. Like there's no fringe. So it's literally from 2012 onwards. I printed off 2011 exam papers, but I think we focus on 3, 12, 13, 14. Okay, so that's the standard, no? Like theory, like with the reflection showing like what do you think of that?
It's okay.
It's okay, yeah? The layout. Yeah, practice. Once you know the layout, it's grand.
See what that's like.
There, we'll just take a break there for 5 minutes.